Continue that conversation. So you guys already know the transactions associated with accounts receivable. I actually wrote them on the board the other day. Well, I wrote one of them on the board the other day, kind of quickly. So when we sell something to a customer, we debit accounts receivable, we credit sales, we debit cost of goods sold, and we credit merchandise inventory. So this really affects that first transaction. What did I say we were going to add? The only thing we were going to add to this transaction in this chapter, the name of the customer, because if we don't keep track of our customer names, then we're not going to collect the cash that they owe us. Because later on, when we sell something to them, we expect them to collect a payment. So when we collect a payment from a customer, that's when we get our cash, right? So we debit cash and we credit accounts receivable. So you think if I added the name when I sell it, what am I going to do down here? I'm going to add the name because I'm pretty sure when you send a payment in, your name's on something, right? The check, the invoice, because you want to make sure that whoever you're sending the check to applies your payment to your account. Yes? You'd be pretty upset if you got a bill that didn't reflect the payment that you made. In other words, it wasn't applied, maybe it was applied to somebody else. That doesn't make us happy. So these transactions here are only changing or modifying them slightly because we got to keep track. So up here you'll see it says, a company must maintain a separate record for each customer that tracks how much that customer purchases, has already paid, and still owes. So you guys remember what we do after we journalize. What do we do? Every time we journalize, what do we follow that with? We post. And we post to the general ledger, right? So we post to the general ledger, and our general ledger, for short, is our T accounts. Okay? We have all these T accounts. Now I'm only going to focus on one T account. Which one do you think it is? It's going to be accounts receivable, right? So we have accounts receivable. What kind of account classification is accounts receivable? What is it? It's an asset. Assets have normal balances of what? Debits. Okay. So accounts receivable. Now you'll notice I don't have the word name anywhere, do I, in here? That's because we can't keep track of individual accounts in the general ledger account. So that's what we're going to see today. How do we keep track of all of these customers, their individual accounts, so on and so forth? Excuse me. Well, it's really easy in a computerized system. Okay, on paper, same idea, it's just a lot more work. So this is just an example of a sale. Sales on credit. I already wrote these up there. The first one is a sale to a customer to record credit sales. A debit to accounts receivable. Notice they wrote comp store name, right? That's all we added. Credit to sales. You'll notice the little asterisk says here that we omit the entry to the debit to cost of goods sold and the credit to merchandise inventory to focus on sales and receivables. So even though this is required, we're just going to ignore it for now because we're focusing on just the accounts receivable component, okay? On July 1st, you also received a payment from a customer. Debit to cash, a credit to accounts receivable. We have been doing those transactions since chapter 4. Chapter 4, I guess. So actually earlier, we did this in chapters 1 and 2. We just did it with fees earned instead of sales. So that's nothing new. All I did was add a name of the customer. But where do I keep all this customer information? That's the question. The customer information is maintained in what we call the accounts receivable ledger. So here's the general ledger. And over here I have the accounts receivable ledger. This accounts receivable ledger is a separate record. It is the details of this general ledger account. So the general ledger account, this is a total of what all customers owe me. So it's the total of what all customers owe. Okay? This accounts receivable ledger is going to have all kinds of, see, this is just a big T, this is a little t's. Mom T's, kid T's. I don't know, I'm a mom, so you know, I always have some kind of reference like that. This is the individual balances of what each individual customer owes. So individual customers. Otherwise, if I don't keep track of who owes me what, right, I'm not going to know a whole lot. I'm not going to know who owes me what, who to send bills to, and who to call up when I don't get a payment, right? All right, so this is like my version, you know, here's the nice version, okay? So if we look up here, look, here's that fancy general ledger accounts receivable. That's my big T here, all right? Anytime we post, anytime we journalize, we post to accounts receivable. You guys have done that before. But now what we're going to have to do is, because we have an additional record that we have to keep track of, look up here. Before I would have posted to just accounts receivable, right? A debit to accounts receivable, a credit to sales. But now I got a name. So how many postings do you think I have to make? Instead of 2, I need to make 3 now, because I need to come over to this record and update it as well. Okay, this does not show up on any financial statements. What shows up is accounts receivable total on the balance sheet. But if I want the details of accounts receivable, exactly who owes me money, then I need to be able to access a separate record. That's what this separate record is. This is the accounts receivable ledger. Now look here, they got accounts receivable ledger. It's still a T account, but it's a T account for each customer. So all the little T's is just a breakdown of the big T. All right, the big T is the general ledger account, accounts receivable. All the little T's are the individual customers. So for example, those transactions we just saw, look, accounts receivable, comp store, $950. Okay, there was a balance in receivables already, so here it is. July 1st, debit accounts receivable went from $3,000 to $3,950. You'll also find that $950 in comp store's personal account. So look, comp store already owed us $2,000. They just charged another $950. Now they owe us $2,950. So I'm going to send them a statement at the end of the month that says this is what you owe, right? RDA Electronics, they sent us a payment, so they must have had a balance, right? So if we look at their account, their balance was $1,000 as of June 30th. They sent us a check for $720. Notice here accounts receivable gets credited. So here's the credit to the big account receivable for $720. But then here we got to go to the individual record up here, sorry, credit RDA Electronics to reflect their payment, right? They owed us $1,000, they paid us $720, now they owe us $280. So when we send them a statement, they're going to expect to see their payment reflected in their account. Does that make sense? So all this is just a detail. We're just going to break down the big T into little t's. And when we add up all the little t's, what do you think they should add up to? The big T, right? So that's what this little schedule is here in the middle. Schedule of accounts receivable is a list of all the customers, their individual balances, and the sum of them. So look, RDA Electronics owes us $280, Comp Store owes us $2,950, and we add that up, we get $3,230. That should be the balance in accounts receivable, $3,230. Okay? So this is the main account. You can see this on the balance sheet. But behind the scenes, we need to be able to contact our customers, send statements to individual customers. So we need a separate record to do that. Now, if this was a computerized system, you know, when we had a new customer, we would go into a certain screen, add all of that customer information in there, right? And then anytime we had a transaction associated with that customer, we would reference that customer's name. That's how the individual record gets updated. On paper, we got to do it this way. You guys have any questions on that one? Okay, I'm going to actually, you guys have your laptops? So I'm going to take a look at week 11 at the very last item in that module is chapter 7, end of chapter exercises. I want to take a look at one of these with you just to make sure we understand how this works. So chapter 7, end of chapter exercises, please. These aren't graded. Why is that so huge? No, I don't want
Maybe. Or you can get that to you.
Yeah, I wasn't even in the right screen to begin with, but I got to see. I might have done that myself last time I was in here. But I didn't think I made it that big. Okay, we're going to do this one because it's just the first question. Just because I want to make sure that we understand how the main account, accounts receivable, and how the ledger, the accounts receivable ledger. This phrase, this term here, accounts receivable ledger, another name for this is called the accounts receivable subsidiary ledger. People don't like that word, but I'm not sure if your book uses it or not. I can't remember because this is a newer edition, but subsidiary. Does anybody know what that word means? It's not subsidiary, it's subsidiary. It's secondary, like a secondary record. So what's the primary record? This is the primary record, right? So the general ledger has the primary accounts in them. These other ledgers are secondary, where we find the detailed information, okay? All right, so has everybody had time to open up this problem for me? You good? Okay, I'm gonna make that a little larger. All right, there we go. So it says, Vail Company recorded the following transactions during November. So the journal entries have already been done for us, okay? Let's take a look at them. Everybody look up here. We're ignoring that second journal entry. This one we're just not paying attention to. It's not that it's not happening. We're focusing on accounts receivable. So look, a debit to accounts receivable, ski shop, a credit to sales. What happened there? We sold some merchandise to ski shop on account. They don't have to pay us for 30 days in the amount of $4,615. On the 10th, we sold some inventory or some merchandise to Welcome Enterprises. So all we've done here, it's a debit to accounts receivable, a credit to sales. We just add the names now, right? So we can keep track. Welcome Enterprises, $1,350. On the 13th, accounts receivable. They give me these names I can't pronounce, or I don't know if I'm pronouncing correctly. Zion Natera, $832. On the 21st, look, that same customer returned something to me. You guys remember returns? Sales returns, allowances, debit, accounts receivable, credit, to reduce the accounts receivable by what's being returned. And then another transaction on the 30th where we sell something to a customer on account. So what we're going to be responsible for in this problem is the posting aspect. So if I scroll down here, and I'm going to make this a little smaller here again, because, okay, there we go. So now there's my account. So there's my general ledger account. Everybody look up here. There's general ledger accounts receivable. Here's sales. That's another general ledger account. Here's my sales returns and allowances. Over here, I have my first, and I wish they would sort of separate this differently, but so these are big T's, right? These are big T's, these three. These are all in the general ledger. The accounts receivable detail is in the accounts receivable ledger. So here's a little T, one for Ski Shop, one for Welcome Enterprises, one for Zion Natera, okay? That's what we're looking at here. So we go back up, look, a debit to accounts receivable for the ski shop and a credit to sales for 4615. So let's go in order. And when I mean that, look up here. We're going to do it this way. We'll post to accounts receivable in the general ledger first. We'll post to the name, the customer name, then we'll post to sales. But now we need 3 postings here, not 2, right? So I'm going to come down here And, okay, what was the date? I already forgot. The 5th. I guess it was the 5th. It's our first one. Okay, so accounts receivable got debited for $46.15. Okay. What's the deal with these over here? I see. All right. So that's up here, guys. Look up here. This is a debit. This is the credit. These outside columns are for dates. Okay. So this date column to the far left goes with the debits. The date column to the far right goes with the credit. Sometimes I think that's confusing, but. All right, so there's our first debit accounts receivable. Why did I debit accounts receivable? Because I debited it up here in my journal entry, right? Now I want to go to Ski Shop, and I want to do the same thing. It's a debit too. So the date is the 5th. I'm going to debit Ski Shop for $46.15. Everyone should be doing this with me. $46.15, right? So there's the detail, Ski Shop. Okay, what did I do here? Sales credit, $46.15. Go find my sales account. Now, this is what I mean. Like, because I'm crediting sales, I want to select the date to the far right column. So 4615, and there I have it. Does everybody understand what I did with that first one? On the 10th, debit accounts receivable for $13.50, credit sales for $13.50, also Welcome Enterprises. So there's the debit accounts receivable for $13.50. That's the main account. But that's a different customer, right, than the first one. So I got to go down to Welcome Enterprises, and I want to select the date there because I need individual records for all my customers. So that was $13.50. You see, the first one was Ski Shop. This one's Welcome Enterprises. I want to keep those separate, right? Even though both of them got debited to accounts receivable, the detail requires me to go and also update the customer's record. I'm going to credit, in this case, I credited sales, for $13.50. So I'm going to come over here and do the same. Everybody good? Questions? Okay, on the 13th, got another customer transaction, a debit to accounts receivable, Zaya Natera, credit to sales for $832. So we go to accounts receivable first, and we debit it on the 13th for $832. Then I go down to the individual customer record, and again, the date's the 13th. The amount was $832. Notice that I'm debiting the customers, right? Think about it, folks. Look up here. If this is the main account and these are the details, and assuming that there's a different customer name for each of these, right? Customer 1, customer 2, whatever, customer 3, customer 4. If these are a breakdown of this total, what's the normal balance then of all of my accounts receivable ledger accounts? If all this is a breakdown of this, what makes the most sense? What should these normal balances be as well? They're all the same, right? I mean, when I add all these up, they're going to add up to this. Therefore, they all have the same normal balances. It's just a breakdown of accounts receivable. Okay, so now what do we have going on? We have a sales return. So we're going to go to the sales returns and allowance account on the 21st and debit that for $209. Customer returned something. So look up here on this credit side. We want to credit the account receivable because they returned it to us. So we have to reduce the accounts receivable. If they returned it to us, they don't owe it to us. So in the main account, accounts receivable, I need a credit. On the 21st, that account should be credited for $209. Why? Because that's what the journal entry says, right? Right here, credit accounts receivable. I also have to go down to that customer, Zaya there, and I'm going to come down to that customer's account. If they return something, they don't want to pay for what they returned. That return needs to be reflected in their account. So when I enter the credit for $209, what happens to that customer's balance of $832? It's going to go down. Look, it goes down to $623, right? They returned something. They don't owe me as much. And then the last one is Ski Shop again. So it's a debit to accounts receivable on the 30th, find November 30 here. For 2713, okay? It's also going to be a debit to the ski shop for the same amount. That's the customer. That's the customer that actually bought the items, right? And then a credit to sales. Okay? So all we did was we added one more posting to these journal entries. And the reason we did that was that so that we had individual records of all of these customers. Now, there is a part 2 to this. Everybody look up here. First of all, don't forget what hint is. A hint is a little video that shows you how to do things. So we could check our work, but I'm pretty confident that it's right. Part 2 asks us to do a schedule of accounts receivable. All that means is we take each customer's name. So the first customer is Ski Shop, and we record what they owe us. They owe us $7,328, right? Let's go down here, Ski Shop, 7328, okay? And then we go to Welcome Enterprises, and they owe us $1,350. And then our last customer, Zaya, up here, $623. Now, when we do that, Connect adds that up for us. What's the total there? 9301. What is the balance of my accounts receivable? Should they match? Yes, they should. Accounts receivable is the sum of all of my customers, right? No details there, no customer names, just the total of what everyone owes me. The subsidiary ledger, and there is the word subsidiary there, that's the detail of what each customer owes me. So when I add all the details up, I should get the same number that is the balance of my accounts receivable. Okay? Check your work if you want. So we're good, right? Complete and correct. Okay. Questions on that one? All right. Back to the PowerPoint here. All right, so we're just going to talk briefly about credit cards. I'm not going to spend a whole lot of time on this because we have a lot to focus on. The reason we focus on credit cards, though, in this chapter is some credit cards are also treated like accounts receivable. For the most part, a credit card is a cash sale. And so, look up here. If I walk into a store and I buy something and I use my credit card, the journal entry is a debit to cash and a credit to sales. It's not on account. On account means that I have 30 days to pay the store, right? But when I use my credit card, what's actually happening? I go and I buy some stuff, swipe my credit card. What happens at that register? Yeah, the credit card company pays for it. Who do I owe money to? The credit card company. So if I go to Dick's and I buy some shoes, some sneakers, right? And I swipe, and my Visa or MasterCard or whatever it is going to pay Dick's Sporting Goods for those shoes. I take my shoes home. Dick's has their money. They don't care what I do after that, right? I go home a couple weeks later, I get the statement in the mail, my my credit card statement, excuse me, and that purchase is going to be on there, right? I have 30 days to pay the credit card company. The credit card company has an accounts receivable on me, but not Dick's Sporting Goods, right? So that's kind of got to think about that. For Dick's, it's a debit to cash, a credit to sales. For the credit card company, it's an account receivable, right? I owe them money. They paid for me, okay? So credit card sales. Now, the only thing I do want to mention here is credit cards. If you accept credit cards in your business, it's not free to do that. Because you can't just say, yeah, I'll take your credit card. There has to be some sort of arrangement you have with Visa, MasterCard, or whoever, right? Because you have to be set up so that that money is electronically transferred into your account. Now, when I go to Dick's and I buy sneakers and I use my credit card, right? Dick's has to pay a fee to Visa. Let's say I use my Visa. Dick's is going to have to pay a fee to Visa for that. Why? So if I buy a $100 pair of sneakers and the fee, Visa charges 4%, then Dick's is only getting $96 of my $100. The other $4 is going to pay Visa for the service. What is the service? Why does Visa need paid? A fee. What are they assuming for Dick's? What's Visa assuming for Dick's Sporting Goods when I buy shoes? The risk. The risk of non-payment. Because if I don't pay, who isn't getting their money? Visa, not Dick's, because Dick's already got their money, right? Visa gave them, right? It's like Visa advanced the money for me, yes? So when I swipe my Visa, the bank, Visa Bank transferred $96 to Dick's Sporting Goods. They kept $4. That was the fee. Dick's sale is still $100 though. What's the fee for? Because Visa is assuming the risk of non-payment. If I don't pay, it's Visa that's not getting their money, not Dick's Sporting Goods, right? So that's a service. That's not free. Visa fees, MasterCard fees range anywhere from like 3 to 5%. So in this example, they use 4%. So it says on July 15th, TechCom has $100 of credit card sales with a 4% fee. So there's my $100, 4%. And it's $96 cash is received immediately on deposit. Using a credit card like that is like cash because the transfer happens pretty much automatically from one bank to the next, thanks to our technology today, okay? So the Dick's would debit cash for $96 because they got my cash, but Visa kept $4. That is an expense. We have a new account called credit card expense. Works the same way as every other expense, but it just means that that company accepts credit cards, and there's a fee for doing that, okay? The credit to sales is still $100. I mean, that's what Dick charged me for the shoes. That's just not the amount of cash they got because they had to pay a fee associated with that. Now, there could be some credit card companies that, like American Express. I don't have an American Express card. I always feel like those are for real important people. I don't know. American Express cards, though, they have different kinds of cards. Some of them, you don't actually get your money till the end of the month, and you have to submit all your receipts. So if I was a retail, let's say I'm a restaurant that accepts American Express, when that customer swipes their card, I don't get paid right away. Part of that is because with American Express, certain cards, not all cards, but the original American Express card, if you had one, you have to pay your balance off every month. You are not allowed to carry a revolving balance. So if you charge $1,000 in a month, you had to pay the $1,000 off. That's the rule with that original American Express card, because it was originally intended to be a bank card. And so with a business card, not a bank card, a business card. And so 30 days just to get your money together and pay, but you pay the balance at the end of 30 days. So what American Express would do is they would wait till their customers would pay, right? And then they would send to the retailer. So that's how American Express typically works. Not all their cards, because now they have a variety of different cards. So that's kind of an example like this here, or a store card. So, for example, if you have a card for Macy's or something like that. So if instead TechCom must remit electronically the credit card sales receipts to the credit card company and wait for the $96. So if it doesn't get automatically transferred over, Visa, MasterCard almost always do. There may be other credit cards that you're willing to accept where you have to submit your receipts to the credit card company first, and then they pay you. In that case, then that becomes an account receivable from the credit card company. So it would work exactly the same way as these do, that's all. So that's the example they show you here. Look, instead of debiting cash, we debit accounts receivable. Later on, we expect to get the cash from the credit card company. So they become a customer just like any other customer. Okay, now here's what we really need to get to. So accounts receivable now, think about this. Money that's owed to you from your customers, right? So this account represents money that is owed to you. If you don't collect it, then you never get your cash. And without cash, you can't pay your bills. So accounts receivable is pretty important. Most companies will have an entire department or certain employees designated to just managing accounts receivable. And you think, well, what is there to manage? There's actually quite a lot to manage. Because there are some people who will not pay their bill unless you call them up and say, you owe us money, please pay us, right? There are others who maybe are having financial difficulties and want to set up a payment plan. You guys have heard that, right? If you call your credit card company, like if you have a question or you want to call or whatever, you call them up. One of those options will be, if you'd like to set up a payment plan, please click 4 or whatever, press 4, okay? That's an option because sometimes you can't pay your bills. So there's a whole department, kind of given that responsibility of collections. maintaining those connections, those communications with customers, sending letters when people don't pay. What happens if someone never pays? What do? If a customer never pays you? Well, you might take legal action, right? Depending on the size of the balance, you might take legal action. So there's a whole thing that kind of goes along with that. What is a bad debt then? What do you suppose a bad debt is? So we have, customer 1 owes us $1,000, customer 2 owes us $200, customer 3 owes us $500, customer 4 owes us $750, okay? What does that add up to? I just made that up. What's that all add up to? $2,450, is that right? Yeah. So that means that that's how much is here, right? So, all the individual amounts would be in here, whatever that is. This would be $2,450, those are the details. So what if customer number 2 says, you guys, the service I got was terrible, I'm not paying you. You can send me as many letters as you want. You can do whatever you want to me, I'm not paying my bill. Okay? Well, there's only so much that you can do legally before you're harassing someone. And if a customer says to you, don't call me, guess what? Legally, you should not call them. They have the right to say that to you. That might not seem fair, but that's just the way it works. You can't keep harassing people. So you have 2 options here. You can go to the magistrate and fill out some papers and pay some fees to try to collect your $200. By the time you're done paying your fees and you collect your $200, you're probably going to have spent more on fees than the $200 you collected. That sounds wrong, I know, but think about it. It's $200. What are most people going to say? Not worth it. So I'm going to just write it off. Does anybody know what that means? You heard that term, right? We're writing this off. It's like people use that term very loosely in accounting. To write off means to remove from your accounting records. Because let's think about this. This $200, this balance could be on here forever, right? Why would it be on there forever? Because that guy said he's not paying me. Do I really want to look at that balance that I know I'm never going to collect every time I print a report to see what my customers owe me? And one of my first jobs was accounts receivable. Each week I'd come in on Monday and I would print out a report and a list of all the customers, their balances, when they were due, how much they owed me. If you know a customer is never going to pay you because they said they weren't, why would you want to see that person on your report week after week after week if they're never ever going to pay you? And the other thing is look, if it's still here, if it's in here, where else is it? It's also still in here, isn't it? Everybody look up here. That $200 is in here, is it not? If you know your customer is not going to pay you, generally accepted accounting principles say that you must be truthful, right, to your external users. You must be truthful to your shareholders. You must be reporting accurate information. If you know you're never getting that $200, then that $200 needs to come out of here, because you're making people think that the value of your accounts receivable, which is an asset, that's a good thing, right? You're making people think that that asset is worth more than it is. So if you know you're not collecting it, you have an obligation to remove it from your records by writing it off. There are 2 methods, and we call that a bad debt, right? Now, I would make a little mental note, I would say, never let so-and-so charge it in the computer. When he comes in again, maybe wants to buy something, and he has a balance, and you have a little note there that says he's not allowed to charge anything, right? That's how you handle those people. Maybe he would never come back to try to buy something, but believe me, it happens, right? So you want to get this out. You want to get this out of this record and out of here. We call that writing it off. There are 2 methods for write-offs. One violates GAAP, the other does not. Even though it's allowed, you can use it, we don't tend to use it that often. So it's called the direct write-off method. I'm actually going to skip over it because I'm not going to spend time on something we're not really going to use. Plus, we don't have a whole lot of time. So there are 2 methods for writing off. And when I say writing off, bad debts or accounting for bad debts. I mean getting rid of them, removing those numbers from our accounting records. The second method there is called the allowance method, so I'm going to jump to that. So some customers are not going to pay their accounts. We call those accounts uncollectible. I'm not able to collect them, so those are bad debts. Jump ahead here. Okay, so I skipped the direct write-off method. Violates GAAP, we're not going to talk about it. The allowance method ensures that we are following GAAP because it follows two principles. It follows the matching principle, which I hope at this point everybody knows. We match expenses incurred with the revenue that's generated by those incurring those expenses in the same accounting period. And before I even show you the allowance method, I'm going to tell you that it does that. It matches, okay? Materiality is a concept that states that an amount can be ignored if its effect on the financial statements is unimportant to users' business decisions. All right, so for example, a $100 bad debt to a little mom and pop store on your corner in your neighborhood is a lot more significant than a $100 write-off or bad debt to Walmart. Right? I mean, that's actually an extreme, silly example, but you get what I'm saying, right? For example, if I said to you, hey, can you loan me $10? You might think, do I trust her, first of all, and if she never pays me back, am I going to be upset? If you say no, then $10 isn't really all that material to you. Now, if I say, can I borrow $20? And you're like, Now, if she doesn't pay me that $20 back, I'd be really upset. Then that amount is material to you. See, it's not the same for everybody necessarily, right? You're a college student. Maybe if I asked you for $2, you'd say, heck no. I don't have $2, right? Okay? Again, materiality is something that is not the same for everybody. All right? Not the same for everybody. But the allowance method is going to ensure that we're following both of those. All right, pay attention. With the allowance method, what we're going to do at the end of the period is we're going to have to estimate. So look right here. Here's this amount. I have to estimate how much of that I don't think I'm going to collect for my customer because I have to report on my balance sheet the amount that I actually think I'm going to collect. So we have a new journal entry we're going to be looking at. Okay? I can look at it in terms of accounts receivable. I can look at it in terms of the total sales on account that I have. This allowance method is one journal entry. We have a couple new accounts here. We're going to be debiting something called bad debt expense. Obviously, we just talked about what bad debts are. And we're going to credit a new account called allowance for doubtful accounts. The allowance for doubtful accounts is a new account. But you have had these kinds of accounts before. The allowance for doubtful accounts is a contra asset. Its normal balance is a credit. And it works against accounts receivable. So, does that sound familiar to you? Contra asset. What other account is a contra asset that works against an asset? What have we already done? Someone, anyone. How about machinery? Less what? Or equipment? Accumulated depreciation. You guys forget already? Allowances in this term, let's pick that apart. Allowance means an amount of money set aside, so to speak. Doubtful means you don't think you're going to collect, right? So, allowance for doubtful, I can't talk at night. Okay? right? On the balance sheet, what you got to show now is the net of those two. So accounts receivable, and since this is a contra account, we say less allowance for doubtful accounts. This is another gap thing, folks. Okay? Accounts receivable, let's say that those are, move that over. Let's say that accounts receivable is 50,000 and my allowance for doubtful accounts is 10,000. Okay? That net amount is 40,000. We call this number net realizable. I don't think I'm spelling that right. Net realizable. I've been teaching this for 23 years, and I still can't spell that word. Is there an E in there or not? Every time I talk about this. You ever have a word like that in your head? That's my word. Okay, so this is an example. We're going to come back to it. What it means is this. Look, this tells, if you're looking at this as a shareholder, a stockholder, somebody else as a bank, this is what you say to yourselves, particularly the bank. Okay, this company has $50,000 in accounts receivable. Those are assets. I could actually sell them if I wanted to. Okay? This company thinks that they're not going to collect $10,000 of those. So the amount they actually think they're going to collect is $40,000. That's important to me as the bank, right? Because I'm kind of trying to figure out how much cash you have available. You're going to be able to pay your bills. Net realizable value means net obviously is the difference between these two numbers, right? When we subtract something from one number from another, we net it out. Realizable in accounting, remember we've got our own language, right? I keep using terms that are common. We realize something, okay, becomes apparent to us. Well, in accounting, realize means convert to cash. So the net cash value, in other words, the amount expected to be received in cash is $40,000. That's what that means. Okay? All right, so Techcom has credit sales of $300,000 during the first year of operations. At the end of the first year, there's $20,000 of credit sales remain uncollected. So that's why there's $20,000 in their accounts receivable account, okay? That's why there's $20,000 in here. And then it goes on to say, it says, Tech estimated that $1,500 of its accounts receivable would be uncollectible. That $1,500 is the amount we use for this journal entry. See, if it's uncollectible, it's an expense to me because I already paid for the product. So it's my expense. So look, $1,500 expense, $1,500 in the allowance, right? So when this company prepares its financial statements, and there it is, look, I don't have to write it up here. There it is. Accounts receivable, $20,000. So that tells me that's how much is owed to that company. They don't think they're going to collect on $1,500 of that. And it's very conservative for me to estimate an amount that I'm not going to collect, because if I extend credit to customers, in most cases, not everyone is going to pay me. Right? In other words, think of your 5 friends. Think of 5 of your friends. Think of loaning each friend $20. Is there one friend that's not going to pay you back? That's the most I've heard on anyone all hour. You're going to have somebody that doesn't pay you back, right? Right. Okay? So, same idea. So look, they only expect to collect $18,500. They have to report those 3 numbers on the balance sheet. That is required. Okay? Current assets, accounts receivable, net. That's the other way they can show it. This is just 2 different. Remember I told you, I think I mentioned this a couple weeks ago. We're going to start having choices, different ways we can do things. This actually meets the GAAP requirements. You can show these 2 numbers separately and the net amount here, or you can say accounts receivable, net of $1,500 of doubtful accounts is $1,850, and then I would add those 2 numbers up to get back up to my gross accounts receivable. You can show it either way. Either way is fine. All right, so what we didn't talk about was how did they come up with this number right here? How in the world do we get that number? We'll save that for Monday, okay? That's where we're gonna pick up on Monday.
I will be here
Okay,
next week, Wednesday, Friday.
okay. Make sure you're watching